Welcome to our guide on avoiding the Roth trap when you start a new job and reevaluate your retirement strategy. In this video, we will explain why prioritizing Roth exclusively can be a costly mistake for many earners, how progressive tax brackets influence lifetime tax bills, and how to apply a smart savings hierarchy that balances both Roth and traditional accounts. We will use clear visuals, diagrams, and quizzes to help you confidently choose your next steps. Let's begin by outlining what we'll cover. Here is the plan for today. First, we will examine why going all in on Roth can backfire. Next, we will compare Roth and traditional designations with a simple mental model: taxed now versus taxed later. Then, we will unpack progressive tax brackets and how they affect your lifetime tax bill. After that, we will walk through the smart savings hierarchy. We will then show how to apply the hierarchy at your new job. We will also discuss situations where Roth still shines. Finally, we will summarize key takeaways and give you clear action steps. When you change jobs, you are often forced to make new retirement plan elections, including whether to contribute Roth or traditional in your 401k or 403b, and whether to prioritize an IRA. This is the moment to reset your approach, because the choices you make now affect your lifetime taxes. The big idea is that many people are in higher tax brackets during peak earning years than they will be in retirement. That matters for deciding whether to pay taxes now via Roth or later via traditional. Let's now compare Roth and traditional at a high level. Roth and traditional are tax designations, not different investments. With Roth, you pay taxes now on your contribution, enjoy tax-free growth, and withdraw tax-free in retirement. With traditional, you avoid taxes today by contributing pre-tax, then your money grows tax-deferred, and you pay ordinary income tax on withdrawals later. Both can be valuable. The essential difference is when you pay the tax. Therefore, optimizing which bucket you use in which phase of life is critical. Now, to understand why this timing matters, we need to review how progressive tax brackets work. Progressive tax systems apply different rates to different layers of income. Your first dollars are taxed at lower rates, and your last dollars are taxed at higher marginal rates. During peak earning years, your final layers of income may fall into higher brackets. In retirement, many people have lower total income and can fill lower brackets with withdrawals. That means deferring income to retirement via traditional contributions can reduce your lifetime tax payments. With that foundation, let's organize a practical game plan using the smart savings hierarchy. This pie chart illustrates a sample diversified approach. The majority in traditional for immediate tax relief, a meaningful portion in Roth for tax-free withdrawals, and a smaller slice in taxable brokerage for liquidity and capital gains flexibility. The exact percentages will vary by person, but the principle stands. Diversified tax treatments to hedge against uncertainty in future tax rates. Next, we will translate this into a step-by-step hierarchy for contributions. Here is a simple, powerful order of operations. First, always contribute enough to your employer plan to capture the full match. That is a guaranteed return. Second, fund your IRA to the annual limit. This account often offers superior investment options and, in the case of Roth-IRA, the ability to withdraw contributions without penalty, adding flexibility. Third, if you can save more, go back to your employer plan and maximize it. In this third step, many savers prioritize traditional contributions for immediate tax savings during high earning years. Now, let's see how to implement this at your new job. To implement the hierarchy, start by enrolling in your employer plan and contributing enough to secure the full match. As a default in peak earning years, select traditional contributions to reduce current taxes. Open and fund your IRA. For many, Roth-IRA is ideal at this step due to flexibility and broad investment choices. After you maximize the IRA, increase your 403b or 401k contribution rate to work toward the annual maximum. Reassess each year or when your income changes, adjusting your Roth versus traditional split based on your current and expected future bracket. Next, a quick knowledge check. Question: what is the first step in the smart savings hierarchy? Options are: A. Maximize your IRA. B. Secure the full employer match. C. Contribute to Roth only. D. Open a taxable brokerage account. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is to secure the full employer match. This is effectively free compensation that you do not want to leave on the table. After capturing the match, you can proceed to maximize your IRA and then return to your employer plan to increase contributions. IRAs frequently offer more investment options than employer plans, which can lead to lower costs and better diversification. With a Roth IRA specifically, you can withdraw contributions, though not earnings, without penalty, offering an extra layer of flexibility for emergencies. Strategically, you can pair a traditional 401k to reduce taxes today with a Roth IRA to build tax-free income later, achieving a diversified tax mix. Now, let's visualize how tax brackets evolve over a career timeline. This timeline shows how your income and tax bracket can change through your career. In early years, with lower income, Roth contributions may be more attractive. As income rises, a balanced mix can make sense. During peak earning years, traditional contributions often provide the best immediate tax relief. In the years just before retirement, careful planning of Roth conversions can be useful. In retirement, lower income may allow you to fill lower brackets with traditional withdrawals at favorable rates. Now let's test your understanding with another quick quiz. Question: when does using Roth contributions make the most sense? Options are A. when you're in a low tax bracket now or expect higher tax rates later. B. always, regardless of income. C. only after you retire. D. only if your employer offers no match. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is that Roth is particularly compelling when you are in a low tax bracket now or you expect higher tax rates in the future. In those cases, paying tax today can lead to lower lifetime taxation. However, during high-earning years, traditional contributions often yield greater immediate benefits. On the left, Roth advantages include tax-free withdrawals in retirement and penalty-free access to contributions. The trade-off is paying taxes today, which can be expensive in high brackets. On the right, traditional contributions provide an immediate deduction, allowing you to invest the tax savings and potentially accumulate more. The downside is paying ordinary income tax on withdrawals later. Generally, Roth shines in low-income years, while traditional is attractive in high-income years. Both together can hedge future tax uncertainty. This decision flow starts by checking whether you receive an employer match. If not, consider prioritizing your IRA, selecting Roth if your current bracket is low, or traditional if eligible and your bracket is higher. If you do receive a match, contribute enough to capture it. Next, ask whether you have maxed your IRA. If not, fund it, choosing Roth or traditional based on your bracket and eligibility. Afterward, increase employer plan contributions toward the maximum, prioritizing traditional in high-income years while optionally adding some Roth for diversification. Here are example 2024 limits. The employee elective deferral limit for 401k and 403b is $23,000, with a $7,500 catch-up for those age 50 or older. The IRA limit is $7,000, with a $1,000 catch-up. The total combined limit for employer plans, including employer contributions, is $69,000, or $76,500 with catch-up. Always verify the current year's limits before finalizing your elections, as these can change. Roth conversions can be powerful in years when your income is unusually low. By converting a portion of traditional balances to Roth during those periods, you may pay tax at lower marginal rates and reduce future required minimum distributions. Another opportunity is early retirement years before Social Security and required distributions begin. Always coordinate conversions with cash flow and withholding to prevent underpayment penalties and unexpected tax bills. Next, let's consolidate key points you can act on immediately. The core points are straightforward. First, follow the hierarchy. Capture the employer match, maximize your IRA, then increase employer plan contributions. Second, favor traditional contributions in high-earning years to reduce current taxes. Third, favor Roth in lower-earning years or when you anticipate higher future tax rates. Fourth, diversify across tax buckets to hedge uncertainty. Finally, reassess annually and after major life changes to keep your strategy aligned with your current circumstances. In summary, going all in on Roth during high-earning years can lead to unnecessary taxes today. Traditional contributions can shift taxable income into retirement, where lower brackets may apply. Follow the smart savings hierarchy to structure your contributions efficiently, and blend Roth and traditional to achieve tax diversification. Use annual check-ins to adjust your mix as your income and goals evolve. Before we close, let's address an important disclaimer. This content is educational and general in nature. It is not tax, legal, or investment advice. Your circumstances are unique, including your income, deductions, state taxes, retirement goals, and employer plan features. Before making decisions, consult a qualified tax professional or financial advisor and verify current year IRS rules and contribution limits. Thanks for watching. If you found this helpful, please like the video, share it with someone who is starting a new job, and subscribe for more practical, research-driven financial guidance. Tell us in the comments how you are balancing Roth and traditional this year and what topics you want covered next.